not sure I can hear you. Maybe you can get the mic closer. And Justin. Yes. Yeah. No. No.
Yes. What? From SBG.
Sorry, let's carry the mic.
Do you hear me better?
Yeah, I think it's better.
So the follow-up question on conflicts of interest. In the request for advice, the Commission asked to consider any conflict of interest related to ESG considerations. In the proposed amendments, the focus is really on those selling ESG products and how conflicts of interest might lead to mis-selling. So my question is, why have you chosen to focus only on those selling ESG products, and why not a broader consideration of it? Because you can, of course, imagine the reverse, that you would not sell ESG products because of conflict of interest. So that's my first question. The second question is really on the taxonomy again. In the papers, taxonomy is also mentioned in relation to vulnerability risk, and I was wondering if you could explain your rationale, because the work that is undertaken by the technical expert group only focus on positive activities. So basically we will only have the taxonomy for activities that are environmentally positive. So in my understanding, it doesn't say a lot about risk. So if you could make your understanding.
Okay, let's try to address this question.
So yes, maybe starting with the comment on the first comment made. I think it's fair to say that it's not only us three here over four, but there's more colleagues involved within ESMA on the sustainability project. So obviously we would always appreciate to have more budget for more staff. I think Stephen and Verena would appreciate that, but in general, I think it's fair to say that it's not only us here, but a number of colleagues that are working on this project, and I think a number of them will also speak later on today. On the conflicts of interest topic, indeed it's a good question. We had discussions about whether or not to include any examples in the analysis section of the consultation paper. In the end, we decided to rather flag it as an open question to stakeholders, to also benefit from your expertise, to see which examples you would see as most relevant. I mean, we had some ideas, but whenever you flag any examples, a lot of attention is given to those specific examples, and kind of other issues and possibilities are often then neglected. So we were a bit cautious of that, so we thought maybe it's better to have it as an open question, and you might have seen it. This was an open question to all stakeholders, so we would very much appreciate if you think that we should provide potentially some examples, and then also whether you believe it should be in the recitals, because sometimes you see recitals have examples, other times it's just more general. So again, we would very much appreciate your input on this. On the comments relating to data, yes, I think this has been something that has been brought to our attention, not only in this context, but also in I think it's one of the main issues relating to the whole initiative, that good quality data is currently difficult to source, and we had discussions internally about whether or not to include more specific provisions on the data sourcing, on where to get the data, how to assess the due diligence on the data providers, and how to process this data internally. But then again, this kind of conflicted with the approach that we took, this high-level principles-based approach. We saw that well, there's a lot of development on the market. There's a lot of data providers that are currently improving their data sets, new entries into this market, and thought that maybe a too prescriptive approach might actually have a counterproductive effect in the end. So I think since you are actually far more knowledgeable about this data providers and the data available, again, we would very much appreciate your input on whether you see the need for us to elaborate more on this and potentially also include provisions on that in the legal text, or whether you believe it's actually better handled outside of the legal text, and this is an evolving industry and an evolving area that should better not be regulated through this level 2 provisions. So we very much appreciate your input on that. But yeah, it was a conscious decision to not go into more detail, although some of the questions you might have seen, we specifically flagged this data issue, whether you see merit in elaborating more on the data sourcing and the due diligence in that regard. But again, we need to bear in mind, I think, potentially also with the principle of proportionality in mind, for bigger fund managers, it might be more easy to deal with this because they already have established processes on how to deal with data, and how they actually do their own due diligence on the data that they receive, and they check the data and how to use it in their internal setup. Whereas for smaller fund managers, this might be more challenging to do so. These are the considerations that we made. Is it really worth to elaborate more in the legal text, or shall we maybe include only something in the analysis section, in the final version, after your input, and basically to give some steer to the industry, but not have it in the legal text. So again, it would be very appreciative if you could give us some input on that, on your views.
I can maybe add my reactions again linked on the topic of data, because we acknowledged during today's discussion that of course the Commission is working separately on the on the S and the G, and that probably the environmental aspects are the ones that deserve more urgent action. On the other hand, I think if you read carefully our advice, one of the messages we gave both in the suitability part and product governance is that probably the idea of working, for example, with a one unique synthetic indicator is not sufficient in this evolving world of sustainable finance, because if one key element is actually identifying what are the objectives that the client is trying to achieve, just doing this with one unique indicator is not a sufficient approach. And the same thing is valid for products. We are aware that, for example, in the excellent work that industry has done on the development of the product governance requirements, the ESG element for now is often dealt with, again, through a unique tick-the-box element, which is this an ESG product, yes or no? So if we want the industry to evolve, if we want this market to evolve, if we want customers to actually be able to reach the products that they need and they want to fulfill their objectives, again, more granular information has to be collected from investors, more granular work has to be probably done by industry on their products, again, of course in line with the taxonomy the Commission is defining, but also in the categorization, for example, for the purposes of product governance, in order to ensure that there is an efficient development. Otherwise, it will be difficult to achieve the objectives that the whole project has to have. And on the conflict of interest, I can only confirm what my colleague Kian had said. If you do see practical examples that you think we should include in the advice, for example, as recitals, we're happy to consider them. I think as of now, we have of course focused on the element of the possible damage to the client, because that is sort of the nature, of course, of the conflict of interest articles that we have, for example, in MIFID II, where there's a tension between the interest of the firm and the interest of the client himself. So in this case, the distribution of new ESG products should be a way to do a better service to the client, to actually act in his interest, and not a way, for example, to obtain higher commissions by selling more expensive products or things like that. So that's why one element of tension that we saw, the most important one, and that we thought we would tackle through the changes to the MIFID II. But if you have again input, we are of course ready to take it on board and consider it for the final technical advice.
I suggest that we go for a last round of questions. So, yeah.
Hi, good morning. Can everybody hear me?
Yes.
Maria Cabezas from Lovario Private Bank. First of all, just to say that I'm in line with what Invesco and BlackRock is saying in terms of definitions and in terms of especially the kind of data that we're receiving from the likes of issuers or other houses of funds. I mean, well, I did a bit of research internally on what it is that we're doing today. The message was clear. We do as much as we can with all the financial and non-financial information and data that we get from third parties, but it would be very helpful to actually have some sort of industry standards, some sort of guidance as to what kind of information we should all be reporting and providing to each other. Because as of today, it's apparently a lot of work to gather different data and make that into something that we can actually analyze and then report. Then second reflection is, and this is just a general reflection, we talk about suitability and sustainability. We talk about incorporating ESG into the target market for product governance, but that only covers 2/3 of our investment services. It covers advisories, it covers discretionary. It lays out everything that is execution only. Not that I want any more requirements or anything, but I'm just saying in line with what the minister on the front row was saying a while ago. If we really want to make a change and work on in as fast as possible, we should not, and regulatory authorities should not forget that there's still 1/3 of the population that still invests on what is known as execution only. Those situations, there's really no regulatory requirement, or there will be no regulatory requirement with the new changes that you're looking at to actually do something about it. So that's my reflection. Then a question that I had for you, and which is linked to all these requirements, is that there's mentions in both the UCITS and the MIFID II consultation paper on how the control functions we need to incorporate in our processes, procedures, etc., sustainability risks, and how we need to monitor. Are you thinking about providing some guidance on how you expect us to do this, maybe by adapting the current guidelines on the compliance function? I think this would be helpful again as of today due to the lack of general regulation is quite complicated to start doing this. Thank you.
I think there is one question.
Can you hear me?
Yep.
Yes. Tamar Kaskuti from the European Association of Cooperative Banks. First of all, I would like to outline that we're very happy with the high-level approach, principle-based approach, and the fact that there is a harmonization happening between Europa and ESMA. So that's definitely something that we are supporting. And of course, as a cooperative banking association, we're also looking at sustainable finance files from the EBA perspective and the CRD review. So of course, in terms of definition, sustainability risks, etc., we look also on the banking side. And I just wanted to flag that there is work in the CR and CRD review, and the report will be coming out where they will also propose a definition of sustainability risks. So on that point, I wanted to comment on a point that Mr. Rava mentioned, that there's anticipation for a sustainability risk definition that covers all sectors, when in fact there's so many different works going on that we anticipate that there won't be one single definition for all sectors. For example, in the taxonomy, if this the scope of the taxonomy is eventually extended to financing products for banks, etc., then the definition is being proposed by ESMA in terms of this consultation and the other sustainable finance files. These won't match in terms of scope. On that point, we still are very supportive of the definition being provided by ESMA, and also in terms of the disclosures proposal file, this seems to be in line as well with the council position. So very much support the position, but thinking ahead, we do not anticipate that there will be one definition for sustainability risks, and this is an issue in itself. Also a comment by Mr. Rava on the indicators, and that someone else as well mentioned before. The papers, consultation papers, ask whether there should be a single indicator or the ESG should have different indicators, for example, in the suitability assessment. Mr. Rava commented that it would be beneficial if it's more granular, there's more detail on that. But we supported someone who previously commented before that perhaps for the time being, since the taxonomy is not in place, then there should be a single indicator for the time being. Because for the very exact reason you gave on granularity, it's just this, you could see from the people speaking today and from the papers, there's just not enough consensus on what the actual definition should be. So I think at this stage it's better to use single indicators to do this assessment. And then perhaps if there's a review phase or something is proposed in terms of reviewing in the next few years, then we can reconsider what if this should be more detailed or if the definition should be extended in scope. And in terms of costs, I noticed there were no comments on costs. We asked some members about costs, and we noticed on the consultation papers that the analysis by yourselves, by ESMA, is that the benefits outweigh costs. This could be very well true, but it depends on a lot of factors. So, for example, if the level 2 is intended to cover all client profiles and there's no cutoff date, so there's few hundreds of thousands of client profiles have to be updated, and the IT systems included, this can very much well run into high costs. So this is something to consider. I don't know if ESMA will be giving a kind of grandfathering provision or a cutoff date if the amendments will be for all client profiles. And in terms of timing, members also pointed out that updating the IT systems and client profiles by quarter 2, quarter 3, 2020 may be a bit tight. So I was wondering what timing you have in mind. I read that you have an 18-month timing implementation, and already before IT systems you need 12 months. Then you need your legal team and your banks to transfer the concepts, which at the moment don't exist because the taxonomy is not in place. So I was wondering about timing because it could be very tight as well to implement all these amendments, especially without the taxonomy in place. Thank you.
Okay, I think I'm trying to manage a bit from a time perspective. Very burning last questions?
Short one.
Short one. Okay, let's go for another 2 questions.
Just a quick comment clarification. Daniel Bolzas from EBF. So some of our members were worried that there's not a clarification in the consultation on MIFID regarding the focus of the consultation itself, the scope. Regarding the Commission's, let's say the Commission's mandate is saying that these requirements should only apply for portfolio management or investment advice firms. Meanwhile, in the consultation by ESMA is not clarified. So they would like to understand if this would be a possibility.
Okay. There are 2 other questions over there. Yeah.
Hello. Can you hear me? Okay. Elizabeth Alford from UCITS Investment Management. First of all, I just would like to echo what my colleagues from Invesco and Reflective have said, and also I think I would also welcome the comments made by representative of the ECB taxonomy, I think there's been a lot of talk about linking the taxonomy to what we're doing here on the suitability test, and I would actually argue that there isn't so much of a link, and I would actually caution against linking it entirely to an EU label, which will be at some point maybe incorporated, but also the taxonomy, for several reasons. And I think there's one particular link that you are making in the consultation paper as regards the suitability guidelines. And the reason why I would caution against it is because we see with clients that there are a lot of nuanced approaches to sustainability. So impact investing, and which would be something which is maybe easier with the taxonomy, or where the taxonomy could begin, is certainly one aspect, but there are other aspects as well, as company engagement, best class, and so on and so forth. So making it too linked to a taxonomy would actually stifle all the other approaches, which are also very important to make the transition from, say, the brown economy to more green or more social economy. But also because taxonomy is not working for each and every product. It's very easy maybe to apply it on green bonds, but it's not so easy on other products. So that's why we actually would welcome a more open and high-level approach in this respect. I think you're doing a great job on other aspects, but maybe on the suitability guidelines, there is a link there which is stifle the development. Thank you.
Okay, and last question, but please try to be concise.
I'll be very quick. It's Patrick Carlson from ICMA. I think we should not lose sight of the progress made already. I think it's very interesting that when I asked members of ICMA what they thought of your consultation, nobody's questioning your, and the commission's in a sense, equating of sustainability risk alongside other well-established traditional financial risk like credit risk and market risk. I think there's already great progress, and I think the fact that nobody's questioning it means that we can press ahead and integrate these changes quickly. My question relates to the word factors, and kind of integrating of ESG and sustainability factors. Maybe this has to do with the mandate you received from the Commission, but we're wondering, everyone agrees on the need to integrate sustainability risk into the investment process in UCITS and AIFMD, but how do we integrate sustainability factors as well? Are they parallel obligations? Is it on the one hand risk, on the other hand factors, or are they the same?
Thank you very much. Let's go to
Yes, so I thank you for all your comments. I will react a bit quickly to the two factual points made, just to try to answer those. And the first one is on scope, which I think is a very relevant question. And I would like to underline that indeed the Commission set out in the mandate that the focus should be the services of investment advice and portfolio management. And I think it's clear that the Commission has done this because only with those two services there is a legal obligation for the intermediary to consider the investment objective of the client, and hence also the ESG objectives that are part of these general investment objectives. On the other hand, it's also true that the Commission advice asked us to change rules, for example, on product governance, and we all know that the product governance requirements apply independently of the service provided. So I think my answer on this will be a bit nuanced, and what is the exact scope will of course depend on the different articles of level 2 that we will be amending, of course, with all the caveats that of the proportionality principle, for example. I can't go into detail now, but that are clear. So again, I would say a little bit of a nuanced point here on saying that we cannot say that we only apply these rules in the case of investment advice and portfolio management for the reasons explained. And the second, just on the timing, which is also a very relevant point, I would like to clarify that it's not really an ESMA decision on when these will apply. The message we gave is that, of course, although we as ESMA have a very tight 30 April deadline, this is only one of the steps for the actual implementation, because then it will require, of course, the Commission to review our advice, decide which amendments to make to level 2. There will be a non-objection period by the other co-legislator, publication in the official journal, and that only then triggers probably what you said correctly, a 12-18 months period for the application. So if you sum all these periods up, it comes up to quite a long period, allowing firms sufficient time, we believe, in order to correctly implement these rules, and also will allow the Commission to complete some of the other work streams that are ongoing, for example, the one on transparency, which will also give more information to firms on how all these requirements should be read together and should be applied together.
Very quick. So on the comments relating to transitional provision, I mean, this is outside of our hands because it will be the Commission proposing changes to level 2, and they would have to introduce it there. But the point is taken. I think we could reflect internally on whether at least to recommend to the Commission something like that. On the control functions, indeed, I think our consultation paper flags that we might provide further guidance in the future, level 3 guidance. So I think this is possible to do in the future. We didn't want to be too specific at this stage, where we are consulting on level 2 changes, but this would be a possibility for the future, either through guidelines or Q&As to be more specific on the expectation relating to the control functions. On the comments relating to data, indeed this is a big issue, and I mentioned this conference that I attended last week at the Commission, early this month at the Commission, and here there were some academic studies that looked at the comparability of data depending on the data provider, and I think they showed that with regard to, for example, carbon data, carbon emission data, Scope 1, Scope 2 emissions, they were more or less correlated, the data available in the market, but with Scope 3 emissions, which are more based on estimations, there you had quite a bit of divergence, so data sourcing became more difficult. But we need to bear in mind, our mandate does not relate to the data providers, but to the expectations with respect to fund managers. So our basically technical report will elaborate on which responsibilities we see in relation to the fund managers. So I think that it's important to bear that in mind, that there are still some improvements to make with respect to data quality, but the bigger question for us is what are the expectations with respect to fund managers, and shall we include some provisions on data sourcing and due diligence or not? So again, you're very much invited to give us input on that. And the very last comment on Patrick, indeed, the comment that you made on factors, it's a very good point. I think there could be potentially different readings on what is the difference between sustainability risks and sustainability factors. I don't know if you probably might have noticed that the Commission mandate in the footnote, they try to give some steer on what factors might be, and there it seems that they consider that the notion of sustainability factors more in a positive term, in the way that these are investment opportunities in the context of sustainable finance. So to this end, again, it goes back to the comment that I made earlier. We specifically, I think, is the first question in the consultation paper, we ask you for your input on all these definition issues, and we would very much appreciate your input on that, so that we could consider it for our work. So, thanks.
Okay, thank you very much for all the very good input and all the questions you have asked us. We hope we delivered some of the answers. We are obviously encouraging you to put all your thoughts into written contribution that you will be sending to us. And I know that the time remaining, the time is pretty short, but I think it's very important that we have your contribution. Obviously, there are some nuances, and I think having heard some of the questions, it's important maybe to clarify. I'm not sure on all those nuances we have the right answers, but I think it's good that we have them on the table and take these through the process. Thank you very much, Madam Kian, and I think we can move now to the next part of the hearing, which relates to the consultation paper on the guidelines for the rating agencies. Thank you very much.